The other big story, of course, was the Prime Minister unveiling two customer-centric schemes by the Reserve Bank of India. These were known that they would be coming into place, but they've been officially launched today. The first is a retail direct scheme where retail investors can now buy and sell government securities by themselves online directly. The second is the establishment of one banking ombudsman, where if you have a complaint against your financial service provider, you can go to this website and file your complaint. But let's just talk about investing in GSECs or government securities. How will it work? Is it a good idea? What is the way ahead? My colleague Alex Matthew has this report.
Exciting times certainly for retail investors like yourself, because the basket of securities that you can invest in has just gotten wider. The Prime Minister today launched a service that is provided by the Reserve Bank of India that allows you to buy government securities directly. So far, you had to go through an intermediary, that is, you'd have to go through a mutual fund which has various fixed income schemes that invest in government securities, bonds of different tenors, that is, of different maturities. Now you're going to be able to participate in both the primary market as well as the secondary market for government bonds. How do you do this? Well, there is a portal that is run by the Reserve Bank of India. It's called the rbiretaildirect.org.in. And you register on that portal, you provide the information that is required. It'll be a series of documents that prove your identity. You'll also have to provide a bank account, and you'll have to sign and send them a scanned copy of that. There is an eKYC process in which you will speak to a representative of the Clearing Corporation of India. And once all of that is done, then you can log into that portal and transact in both the primary as well as the secondary market. Now, a few things that you need to bear in mind is that you need to tread with caution before you actually start trading in this market, because there is a potential of losing capital because of the fluctuation of interest, which affects the face value of the government securities. So do take advice from your financial planner before you actually go out and trade in these securities. However, if you buy to hold to maturity, so for example, if you're buying a new 10-year security and you're holding it to maturity, there's nothing to worry about. It functions almost entirely like a fixed deposit. The taxation is also similar to what you would find on a fixed income scheme that is run by a mutual fund, in that anything less than 3 years in terms of capital gains gets taxed at short-term capital gains tax rate, and beyond 3 years it gets taxed at long-term capital gains with indexation benefits, and the interest rate sits on top of whatever you earn in the year and gets taxed at slab rate. So it's exciting times certainly. It requires a little bit of study before you choose to go for this option.
It is a very interesting time right now, not just for the Indian economy, but for the global economy as well. Right now in India, we're perhaps at our most optimistic in nearly 2 years. The festive season has gone by very well. We have reports of increased demand in almost all sections. Infections are still in a very controlled manner, small spikes here and there, but nothing which is alarming anyone so far. And vaccinations are progressing along at a decent pace. Where do we really stand as far as economic recovery goes, especially at a time when demand is increasing, but supply side constraints are also giving signs of worry? This is causing inflation all over the world, and you're probably seeing it too, with prices of a range of commodities going up. To get a sense of what we can expect going ahead and where we stand right now, I'm joined by a very special guest whose take on the economy is well revered. Let me welcome Arvind Panagariya. He is, of course, Professor of Economics at Columbia and the first VC of the Niti Aayog. Mr. Panagariya, thank you so much, and great to have you back on the show. Let me begin with that basic question. How do you summarize where we are right now? Is it perhaps the best outlook that we've seen in quite some time?
It indeed is, Tamanna. You said 2 years ago, but even if you go back 2 years, you know, our last pre-COVID year was not so good. We grew only 4%. From where we now stand, I think it is even better than that. Not only, the economy generally is looking up, but also the fundamentals seem to be now in a stronger position than they perhaps were going into COVID. I mean, going into COVID, our financial sector was quite weak. But it seems, I think we still need to be cautious, but it seems to me that the books, balance sheets of both the banks as well as the corporations now look considerably better than they did going into COVID.
Okay, let's look at one big change that we've seen is the return of demand. Now, should we view this as demand which is spurred on to some extent by a festive season, seasonal demand, a bit of revenge buying, or an upswing after the second wave had faded? Or can we hope for this to sustain? And how crucial is it if it sustains?
There's no question, it is very crucial for us to sustain it now. But therefore, the bigger question really is that will it sustain? And my sense right now is that it will sustain because the momentum is just very, very strong. I mean, even going by the fact, and this is around the world, it's not just in India, that once people begin to feel safe that yes, we can go and shop, we can go and work in our workplaces. At Columbia University, where I teach, we are now we have been for almost close to 8 weeks into in-person classes. And my energy is so much better back than it used to be on online courses. I think people want to be back. They want to be able to spend, and they want to be able to work as well. So I think this is going to sustain. And moreover, we can come and talk a little bit more in detail, but lots and lots of reforms have been done during the pandemic. And also some of the ones that had been done before pandemic had not found their full effect. And so I think all this really adds up to a virtuous cycle. So I'm very upbeat now.
In all of this optimism and all of this upbeat mood, there is one fly in the ointment. There is one very clear dark cloud in the sky and on the horizon is that of inflation. The CPI numbers which came in today for October have shown a mild uptick, and some relief has come from the excise duty cuts on petrol and diesel. But overall, things have become more expensive. It's just because there is a supply chain choke and it's a global situation. Do you see this spoiling the party down the line?
I'm quite okay as long as we can contain the inflation, below 6%. In India, sensitivity seems to be a little bit higher, maybe, so therefore anything beyond 4% is seen with a bit of a horror. But personally, I think, for a growing economy, and particularly one that's coming out of a pretty long pandemic, if we hit up to 6%, that is within at least my tolerance limit, almost kind of, not on a long-term basis, but for a short period, it's something that can be sustained. Now, moreover, as we kind of, unblock the supply supply blockages, I think the supply side will give way and inflation will come down. Moreover, we got a very competent central bank, so the central bank is watching as well. So on food inflation, they can do less, but I think on food side, we are doing okay because, the stocks are good and agricultural response during the pandemic was quite reasonable, So that is the kind of one area where we have to be quite cautious, but I think we are. On the rest, the actions by the central bank can also help us. So I would not be pessimistic on that one account.
So when we talk about the actions of the central bank, many are wondering whether we are now moving into an era where interest rates will have to be perhaps increased to some extent, looking at how inflation is moving and other indicators. Do you think that we are coming to that stage yet, or is it wise the way our central bank has held back, even while other emerging economies and their central bankers have decided to increase interest rates?
No, I fully endorse actually so far what the Reserve Bank of India has done. By being restrained on interest rates, it has actually given room to demand to expand, and that is very, very desirable. It should remain measured in this way. It should be cautious, but not act preemptively on the interest rates. Even the United States, so far, I think now the latest inflation figures in the US have gone beyond 6%. And so we are expecting that Fed will take action, but it hasn't done it yet.
Yeah, I was just going to come to that where you are right now. I think the hottest topic is inflation. It's become a mainline trending topic even for late night comics. We're talking about how the price of everything from a carton of milk to a used car to any food item has shot up. Tell us whether it's, how it is a big sense of worry right now in the United States.
It is both, because remember that the US for a long, long time has not seen this kind of, inflation rate. This is, I think, for the first time in 30 years that the 6% barrier has been reached. And normally, it has been in the range of 2 to 3%. And if you recall, the big kind of concern in both Europe and the United States had been that inflation was simply too low, and therefore that was pushing the policy interest rates in the negative territory. And Europe actually was having negative interest rates as well. The US did not go that far, but so now this is suddenly, it is quite a turnaround from that situation. And certainly the consumers, including ourselves, we notice this in the supermarkets. The prices really have gone up, and my wife complains whenever we shop, all the time, that how rapidly the prices have gone up. So, but from the policy perspective, of course, that means that the Fed has to now act because they also were being restrained on this because they didn't want to preemptively choke the recovery. So that's where we are.
What is going to be the impact of that? Is the Fed's expected action, which seems fairly inevitable, and the problems that the United States and other countries in the world actually are also facing, high inflation, is that going to have a ripple effect? What does it mean for India?
Well, when interest rates rise in the United States, then capital, returns to the United States from wherever it is, from outside the United States, that is. And specifically, it impacts the emerging markets more because, European economy taken as a whole is reasonably large, and therefore such movement in or out, it can absorb a little better. But for the smaller emerging market economies, what is a small percentage of GDP for the United States is a very, very large percentage of the GDP for the emerging market economies. So this impact is always felt. And so therefore, again, on that front, the Reserve Bank of India will have to be very cautious because as capital goes out, obviously it's going to impact the exchange rate. And so some interventions probably by the Reserve Bank of India at that point may be required. But the good news for us is that, the Reserve Bank is very, very well equipped with something like $600 billion plus worth of foreign exchange reserves. So it's both credible and it has got the necessary ammunition. So it can be handled.
Of course, because of the reasons that you mentioned, it's been a worry for investors in equity markets where a lot of foreign funds have been adding to the liquidity that we've seen. Indian stock markets have been on a tear and there is this whole slew of new, internet companies or consumer internet companies who have been coming with IPOs. Your thoughts of what is happening in the Indian stock markets? There is one section of people who think that, we're heading towards a big bubble, and when it will fall, it will hurt. The other side of this believes that we're just at the beginning of a long bull run. Where do you stand on this?
So, look, I'm no stock market expert. If I were, you would not be interviewing me. Yeah, so they're both forces at work, right? I mean, in the United States, certainly, we now see as even the threat of interest rates seems to be adversely impacting the stock market. And there's no doubt if the Fed does actually raise the interest rates in the US, certainly the stock market will be majorly impacted because the money will move into debt instruments from the equities. Something similar to some degree will happen in India also. The real question is that, about the expectations for the future of the economy, because India is a different economy. It's not a 2% growth economy on a sustainable basis, but it's more of an 8% sustainable growth economy. So in that, and my own assessment is that we will grow at rates like 8% for the next couple of decades. And so, that puts a very different kind of twist on the expectations. I mean, if that's what drives it, then it is real, stock market is actually responding to real good times ahead. And stock market always kind of tries to predict, right? It's not based on what is happening today. Stock market prices often are very, very predominantly kind of determined by what is to come. And if that is what the market is reflecting, then it is reflecting a reality. So we will still see actually the stock market on balance, in spite of some increase in interest rate that may happen down the road, would continue to rise probably on a long-term basis. Small daily fluctuations, of course, are always there.
Yeah. Let me come back to economics now, what you're more comfortable with. So when we talk about India's economic recovery, and like you've said, India has decades of 8% consistent growth in front of it. The good times have begun. Do you see enough of an effort or to ensure that this growth is equitable? Even when we talk about what has been happening this festive season, we've seen a widening disparity. So luxury homes, luxury cars, luxury items are selling like hotcakes. But for example, in automobiles, two-wheelers and entry-level cars are not seeing that kind of demand. There is a bit of a widening gap. Does that concern you as an economist?
Well, I personally am much more concerned about poverty than I am about inequality, because poverty is something about which policy can do. I mean, tons of discussion happens on inequality, but tell me, which country actually through policy has turned inequality into equality. But I can tell you a number of countries which through policy have impacted poverty in a major way. So I put my effort where I think impact is possible. And to some degree, if we help the poor, then inequality is also reduced. At least the inequality, which is the most offensive one, is reduced. So yes, there I think we can do something. And for that, I'm not perturbed so much by the growth. I mean, growth tends to be concentrated. It concentrates in urban areas. It concentrates in industry and services as opposed to agriculture. So we would see those kinds of disparities coming through. But this is where growth also gives us the revenues to redistribute to the poor. And the very fact that today we have these fairly large, fairly substantial social expenditure programs is the result of the growth that we experienced since 2003-04. And I think we need more of it. And then, this can be, the redistribution can happen through expenditures. Let's not do things, there is some tendency sometimes to turn every single instrument into an instrument of redistribution. I think that then hampers growth. So let's, first let's get our policy regime such that economy can grow, then use the tax revenues to do the equality through expenditures.
Absolutely. Just one point on India's sort of economic parameters. Do you think at this point fiscal deficit is going to be anything of a concern for India? We've given ourselves leeway in light of the pandemic, but there seems to be a charted course to reduce that gap going further. There's already a target and a goal map in place. Do you think it should be a matter of concern, especially when crude seems like it will upset the apple cart again?
You know, at some point we do need to return to fiscal consolidation, and that maybe one can make a good argument that that point may not be here right now. But what I would suggest is that, you know, equally important, probably more important, is the quality of the expenditures. So the government should try as much as possible to keep the capital expenditures going. Building up of infrastructure is extremely important. The government has done reasonably well, I should say, actually, in the recent years. Accelerated road building, bridges, the Gati Shakti project that it has announced and all. So these should not suffer, I think, you know. I mean, if the, if the bottom line is that fiscal consolidation is going to impact in a major way the infrastructure spending, then I would be a little hesitant to do that. But if we can cut some of the other expenditures, and certainly our revenues are rising. So, you know, that ought to be the way, you know, let's raise the revenues further. Perhaps some more fixing of the direct taxation. I think, you know, there the base of taxation is relatively narrow. Let's try to find ways to broaden that tax base. So work a bit more on the taxation side also, but consolidation will have to be done. So let's not, you know, downplay the need for consolidation. That can come maybe a year later, but it has to begin happening.
Well, thank you so much for speaking with us today, Mr. Panagariya, and giving your perspective on where the Indian economy is at this moment. For now, it seems, fingers crossed, that the worst is behind us. Let's hope we only go from strength to strength.
Yes, my pleasure, Tamanna, to be with you once again.